Well, good morning. Hi, everyone, and welcome to our webinar on cash flow strategies for growing businesses. We're excited to have you join us today. I'm excited to share that I have the privilege of sitting with Sandra Josephs, who's the head of underwriting for Northern Bank. So welcome, Sandra.
Thank you, Yvette. Welcome to you too.
Thank you. So my name is Yvette Korecki, and I'm the head of cash management here at Northern Bank. So we just wanted to share a little bit about yourself, Sandra.
Thank you, Yvette. So, as Yvette said, my name is Sandra Josephs. I'm the head of underwriting here at Northern Bank. I've been with Northern Bank for 10 years, and in my capacity as the head of underwriting, I manage the commercial loans department from an underwriting perspective. So, my team of 10 commercial credit analysts underwrite all commercial loans, all of our businesses, commercial loans for your commercial real estate acquisitions, your CNI, your franchise loans, they're all underwritten by my team.
It's amazing.
Thank you.
Great team you have
Thank
here,
you, Yvette.
Sandra. So just a quick notes here before we get started. So we just ask that all attendees that your cameras are off, your microphones are muted. To ask any questions, please submit your questions via the chat. And please know that if we don't have the opportunity to get to your questions or get them answered to your specific question on the Q&A, we will connect with you directly. And this session is being recorded. If you don't feel comfortable, please disconnect now, and we'll send a recording of the webinar to the email you listed in registration. So with that, I say we kick it off. Sandra, how do you feel?
I'm ready to go.
All right, fantastic. So why don't you kind of go through these and just share with us? So we think about our, mantra here at Northern, which is know and grow. So our webinar overview today is going to be about understanding cash flow dynamics of growth, how to know if you're ready to expand. That's a big question that we see, right? How to know about funding options, matching tools to strategy, and what does a lender look for? And then, of course, we'll go through the Q&A.
Absolutely.
Wonderful. So we're going to hit it real hard right now, Sandra. We're going to go right into understanding cash flow. So types of cash flow, right? We'll go through these here and kind of operating cash from core businesses. This is, for you to kind of walk through. So I'll turn that over to you.
Absolutely. Thank you, Yvette.
Thank you.
All right. As Yvette alluded to, 3 types of cash flow that we look for: operating, investing, and financing. And we're going to be going through all 3 to get you better acclimated to what these are. So your operating cash flow is how lenders look on the money that is moving in and out of your business. There is a common misconception with cash flow, and the common misconception is it is not profit. It is your operating cash flow. Can your business generate cash? And this is the cash that should come from your core business operations. Now, whatever your business is doing, is that generating cash from its core functionalities? Now, this can be cash received from your customers because you are selling on credit. And as I've said, it's cash moving in and out of your business. So it's also cash that you're paying to your suppliers, cash that you're paying to your employees, cash that you're paying for rent, etc. So this is the most important of the 3 cash flow. If it's weak or negative over the long term, the business has problems. But in the short term, we expect that this cash is working because your working assets should be turning and generating positive cash flow. The second cash flow is investing cash flow. Now, this is how are you spending money to grow? This is cash that's used for or generated by your investment activities. Acquiring a business, buying equipment, buying a property, or investing in software, these are all cash that you're spending on investment. Well, the opposite is you can sell an asset or you can sell businesses, and these are cash that's generated from investments. Now, these are usually negative for growing companies because they're investing in the future, and that's understandable and expected. Now, as your business grows and expands, and your business becomes more stabilized, we expect that this kind of cash flow to become more positive because you would have invested in a lot of asset over time that will start generating cash flow and turn that negative trend into a more positive position. The third cash flow is financing cash flow, and this is how is the business being funded. Now, this shows cash related to your capital structure, how the company finances its operations and growth through debt and equity. And equity can be common stock. You can issue common stock to build your capital structure, or you can retain your earnings, retain your net profits, leave them in the business. That also strengthens your capital structure. It's also borrowing or repaying debt. It's issuing or buying back shares and paying dividends to shareholders. Now, this shows how the company funds itself and return money to its owners and also to the lender.
That's a lot of information, Sandra, that I think a lot of our businesses are not familiar with, or maybe they may, have a hiccup or have a question and they say, I didn't know that. So I think that's why it's so important for us to review this. And thank you for sharing, because that's really important for us.
Thank you, Yvette.
So now we're going to jump into key financial statements and the story that they tell. And I think this is really important because we always want to tell the story. We tell the story about Northern Bank and how we got started. I just think it's so inspirational when we hear our small businesses tell us how they got started or where they got the idea from, and then sharing how they grow.
Absolutely. So our key financial statement and the story that each tells. Now, our first key financial statement is our income statement. This is the performance story. Now, did you make money? The ideal question, did you make money? So your income statement, what it tells you is how profitable is your company? What is your cost structure? And what that means is how are you pricing your cost of goods sold? What are your margins, your gross profit margin, your net profit margins? Those are two very, very important margins for you to know as a business owner, because they're both telling a story about operational efficiency and how well you're running your business. They also, the profit of the income statement also tells whether your earnings are growing or shrinking, because year over year, you're going to look at a comparison to see, okay, how is my business operating from an income perspective? Are my revenues growing? Are my revenues stagnant? Are my revenues shrinking? Now, one of the great misconceptions about profit is persons believe that profit equals cash, and you can still look profitable and run out of money. Profit does not equal cash. The other key financial statement is our balance sheet, and the story it tells is the position story. What do you own and who do you owe right now? It's a position story. It's a moment in time. It's not over a specified period. So it tells you what your financial strength is. It tells you what your leverage is. It tells you what your liquidity position is. Are you able to meet your short-term debt obligations when they become due? And this is very important for the lender because we want to know that your current assets, your working assets are generating enough money to pay your current liabilities as they become due. This also tells us what your capital structure is and what your risk appetite is. Capital structure in terms of how healthy is your balance sheet. Do you retain earnings in your business or do you pay them out? The snapshot of this is it's not reflective of your performance over a period, but it's just a moment in time. The next statement that we look at is your cash flow statement. And the story that this tells is the reality story. Where did the cash actually go? And this tells us your business's ability to generate cash, the sustainability of your operations, whether your growth is self-funded or debt-funded. And there is nothing wrong with either, and there's nothing wrong with having both be a part of your borrowing structure. You can inject money in your company to fund your expansion, your operations. You can also borrow to fund your expansion and your operations. It's a healthy mix that will set you apart and get your leverage to a position where you feel that you're not over leveraged. You're not borrowing too much, but you are also equally invested in your company. So the key insight to this is that cash flow keeps your company alive.
Outstanding, Sandra. And one of the things I think about is when we talk about the story, as we're asking these questions to our small businesses, whether you're going out to visit a client or you're just the client itself, it's better to tell the story and explain and show the proud, being proud of how you've grown, but also, it's okay to say, I don't know how to do this and ask us because that's what we're here for, right? It's fantastic. So I'm going to transition now to why do banks focus on EBITDA? So I think that's a word that a little people may be apprehensive about. So we can talk a little bit about what EBITDA is maybe, and then share with us how you look at it, Sandra.
Okay. So EBITDA, yes, it's a very wide statement for our customers, but it is something the bank looks at very, very, very closely. So EBITDA, earnings before interest, taxes, depreciation, and amortization. So EBITDA tells lenders how much of an earning power a business has to repay debt. And this is before financing structure. Again, comes back to your core business operations. From your core business operations, how much money do you have and what is your earning power in repaying debt? So it's one of the first numbers that lenders look at because we're checking for your debt capacity. We're looking for the business operating strength and repayment potential. It shows core operating performance. Now, the bank wants to know if your business is a landscaping business, the core operation is landscaping services that you provide. Is that core business generating enough money, or are you, as the business owner, having to inject money into your business each year to offset your expenses? That would suggest that your core business is not operating as efficiently as it should. So the bank does look at that. They focus primarily on EBITDA in making some determination about your ability to service debt. We look at consistency and predictability. Consistency meaning, are we seeing a year-over-year trend in that you're having positive EBITDA year over year?
That is amazing to hear because, again, I think sometimes when you're looking at this from the client's shoes, you see these words and you're not obviously familiar, right? Bank jargon is what we like to call it, and they don't truly understand. So I think that breaking it down the way that you did just makes it a little bit more absorbable,
Absolutely.
if that makes any sense. So thank you for that.
You're welcome.
So now we're going to see, how do we know, or how does our clients know if they're ready to expand? Because that's a big question that we get as well. Over at Cash Management, we get a lot of clients that say to us, I think I'm going to move and grow, and how do I get there? So I think that transitions us to more of your expertise, Sandra, about how do you know if a business is truly ready to expand?
Thank you, Yvette. So if your company shows profitable growth, strong cash flow, solid liquidity, and control leverage, it is financially positioned to expand with lower risk and greater confidence. Some indicators of your readiness to expand are financial readiness indicator, operational readiness indicator, and risk assessment. And we're going to go through all three. So financial readiness indicator, we're looking for consistent and predictable cash flow. Is your business showing stable month-over-month revenues and not one-off spikes? We want to see consistency and predictability. Bearing in mind that there can be spikes in revenue, but we tend to want to look at core recurring revenue stream. It should also show your ability to forecast cash flow for at least a 3 to 6 months period ahead. If your business model doesn't generate or show that you can generate cash flow in a 3 to 6 months period on a consistent basis, maybe you're not ready to expand. It also shows that seasonal dips are planned for and not treated as emergency. Now, if you're a seasonal operation, as landscaping services are, they're more for the summer months. Come winter months, we want to see that your company can support itself during that downtime. that you're not necessarily borrowing to meet payroll because you have no revenue stream coming in because you're not really operating for the winter months. Wasn't planned. So those are some of the three things from a financial readiness capacity that needs to be addressed, or you as a business owner needs to look at before you can determine if you're ready to expand. Now, from an operational readiness capacity, we should show whether your day-to-day operations can handle the growth, the expansion without breaking. So what we want to see is, do you have documented and repeated processes, tried and proven? These are what we've been doing year over year. They work for us. We're ready to expand because these processes are in place, documented and proven. We want to see if you have the capacity and the resource to expand. Would you need to hire more staff? Is your existing staff complement enough to support an expansion? Are your systems and tools up to date? Would you need to invest in capital expenditure, improving on your software, change out your computer systems? Is your supply chain reliable enough to support the expansion? Are your suppliers on the same trajectory as you are? Are they going to be able to supply you with the goods that you need to support your expansion? And the next one would be financial readiness in terms of risk assessment. Now, this assesses whether you've identified, understood, and planned for the risks that come with growth, and not just hope that they won't happen. You need to plan for the risk because as you're expanding, going into new markets, there are risks associated with it. If it was a risk-free world, then we all would be expanding. But planning for the risk and preparing for it sets you apart.
So plan for the worst.
Plan for the worst. Identify the risk, analyze the risk, evaluate the risk. Do not be afraid of the risk. Treat the risk and just review and move on. So some of the risks that we can identify that you need to follow are financial risk.
Sure.
Would expansion fail or threaten your core business operations? Your business is still operating, your business is still here. If you were to expand tomorrow, is that going to lead to you having to shut your business down if that expansion fails? So if growth fails, can your business recover?
Yes.
The operational risk that comes under risk assessment is, will expansion overload the existing system or your team? Growth will expose operational deficiencies, and you have to make sure that your team and your systems are in place to support that growth or that expansion. Now, there are market risks as well. Are your demand assumptions validated? This is very, very important. You cannot just be overly optimistic that there's going to be a demand for your product. You have to do some research. Is there really a demand for this product? Scaling into the wrong market can be a very, very expensive lesson. And there's execution risk. Is your expansion timeline realistic? Do not put a timeline of 3 months to expand your business when realistically this should take 2 years. You're going to defeat a lot of the progress that you've made, and you're also going to damage your structure.
A lot to consider. I think what stuck out to me, what you're sharing is the market risk is something, because you see there's a lot of fads out there, or there's, you have that expectation where you like you said, you want to grow in 3 months, but in reality, it should be a 2-year growth, because then you're taking the time to really do the research, do the homework, and make sure that you're setting yourself with the right expectation, because it's not just you, it's everyone that's in your core, as you alluded to.
Exactly.
So thank you so much for sharing, Sandra, on that. I think that was really important as well.
Thank you.
Now we're going to talk a little bit about funding options and matching tools to strategy. So I kind of think how this flows so well and marries. So talk us through a little bit about matching those tools.
Okay. So there are 3 different stages. There is the early growth stage, there is the moderate growth stage, and then there is the major expansion stage. You've decided that you want to start a business, right? You're in the early growth stage aspect of your business. How do you fund this business that you're about to start? Now, you can fund this by owner's capital. You can literally just inject your own money into the business. And this is an ideal source of financing. It costs you nothing. you're invested in your business, and it actually shows banks and potential lenders of your commitment. You have something to lose. You're willing to inject money into your own business, into this idea, into this concept that you have, that you want the bank to ultimately partner with you on. The early growth stage also requires you to get probably some small business loans. No, you're not going too deep in the early growth stage. You're probably buying some equipment. You're probably leasing a piece of real estate. You're hiring, but you're doing it on a lower scale, on a smaller scale. So these elements for early funding is ideal.
Mm-hmm.
Now, when you get to the moderate stage, the moderate growth stage, there are other aspects that are available to you. Now, these are when you start thinking, okay, I'm ready to branch out a little bit more. I probably want to open a second location. Now, there are bank terms loan that are available to you. There are lines of credit, revolving credit, equipment financing and leasing, because you're expanding your business on a wider scale. You're going to need more equipment. There are venture capital as well that's out there that's available to you. And when you get to the major expansion stage now, you talk about private equity, corporate bonds, SBA 504 loans, long-term bank loans. One of the key here is to match the funding to the business strategy and what you're looking to do. And the reason why I say that is you want to make sure that the funding that you're availing of meets the expansion needs of the business. So if you want to acquire real estate because you were renting and now you're in a position where you want to buy your own commercial real estate to expand into, ideally you should get a long-term loan for that, which is a commercial real estate mortgage where you have a longer amortization period, as opposed to getting a term loan that you get to repay in 5 years.
5 years.
You're buying a solid piece of real estate that's not going to start generating any kind of returns for you. So you want a longer repayment option so that you're not kind of stifling your cash flow to make payments on a commercial real estate loan for 5 years as opposed to a commercial real estate loan for 25 years. So it's very important to match the funding with the tools. Say, for instance, you collect receivables on a monthly basis or every 60 days or every 90 days. It is ideal for you to get a line of credit whereby you can pay down that line of credit each time you collect on your receivables. That will help you bridge the gap between the timing that you're collecting on your receivables and give you enough time to pay back the line of credit and have recurring use of it.
Okay. That's amazing. So I kind of think, putting all your pieces together there, especially this matching tool, sounds a lot like what you were just talking about in the prior slide, which is plan, think it through, make sure you're taking those steps. And before you go from early to moderate, you've done the research. And that's why it's so important that you don't jump and do a small 3-month plan and have that extension.
Absolutely.
So right there. Thank you.
Thank you.
So now we're going to look again at what does the lender look for, right? What are the core financial lenders review? So this, I think, is super important because it gives an inside view to our teams out there and our clients of what it is that we're looking for. So it's kind of like a peek behind the curtain, if you will. So Sandy, please let us into your world.
All right. So core financials that we review, there are 3 core financials that we review: the income statement, balance sheet, and cash flow statement. We've talked a lot about cash flow statements, but we're going to talk again on all 3. There's a lot of repeated processes here, but it just reinforces the importance of all 3. So the income statement. The income statement is also called the profit and loss statement, and it shows a business's financial performance over a specific period. So lenders review it to assess profitability, sustainability of earnings, and again, your ability to service debt. We cannot stress that enough. A stable or growing revenue indicates that your business can generate cash to meet loan obligations. And what lenders look for, particularly on your income statement, is trend over time. We're looking for growth, we're looking for stability, or we're looking for decline. The income statement is going to give you all 3. We're looking if there's any revenue concentration. Is there any dependency on a few customers, or is your customer base diversified? And obviously we prefer diversified, but if you do have a concentration on customers, we'll take a little bit more look at who those customers are. Are these very established businesses that we believe will also be staying in business as a going concern, so you can continue to rely on them, so we can continue to rely on you and having them as a source of cash flow. We look at the consistency and reliability of your income.
Sure.
Again, year over year, repeated growth. And if there's any stagnation, what are you as a business owner doing to cure that position? Are you going to be expanding? Are you going to be ramping up your marketing? Are you going to try to invest in software that's going to, upgrade your systems? What are you doing if your business is demonstrating stagnant income? Then we look at balance sheet. The balance sheet provides a snapshot of your business performance over a specific period in time. Now, again, it's not performance over the year. It's just a point in time. It's a snapshot. So we want to look at your financial strength, your liquidity, your leverage, and your solvency. The balance sheet helps lenders to judge how well a borrower can withstand risk. Now, we want to see that you're leveraged, that you're not overly leveraged, that you have the right amount of owner's injection coupled with bank debt. As I mentioned before, there's no right or wrong in terms of what the percentage is. It's just a healthy balance of it. Then we again look at your cash flow statement. Now, is your operating cash flow positive over multiple periods? The cash flow statement shows how cash enters and leaves the business over a specified period. And what the lenders use it to do is to assess liquidity, repayment capacity, and operational efficiency. And one thing we have to always bear in mind is profits on paper don't always translate into cash available to service debt.
And that we see every day. That is a great breakdown and great understanding, because when we, again, going out and seeing clients, a lot of times they have someone that is doing this for them. And it's just so great to have this education behind it. So thank you, Sandra, for that. So we're transitioning now to what lenders are really assessing. So this is another, I guess, peek behind the curtain, if you will, opportunity for our teams out there to kind of take a quick look at what is it that we're really, really assessing. So right back at you, Ms. Sandra.
So the three things that we're looking for, as you see on your slides: cash flow consistency, ability to repay, and quality of financial reporting. Is your cash flow steady month to month? Is there consistency? Is there reliability? Is there predictability? Numbers are driving the bank's decision in determining whether we lend you. It is a financial risk, and the bank wants to make sure that the numbers speak for themselves. So we're also looking if there's large fluctuations in your cash flow. And if there are large fluctuations, we will likely discount it, because again, we're looking for the recurring cash flow that's coming from your core businesses, not those one-off spike, not if you sold a property and had a $2 million capital gain on the sale of that property. Unless you're in the business of buying and selling real estate, it's highly unlikely that that's going to be a recurring income stream. So we are going to eliminate that from our assessment, because we're looking for core, consistent, month over month, predictable, if you want to call it, cash flow. Now, your ability to repay, we're also looking for cash flow consistency. What are your existing debt obligations? Are you in a position to take on additional debt without straining your operations? What is your financial history? Have you borrowed from us before? How did you repay those loans? Have you borrowed from other banks? We look at the guarantor's personal credit report to see how they're managing their own personal debt, because that can also be indicative of how they'll manage your business debt. We look at your liquidity and if you have any reserves, and we also look at collateral if the loan is secured. Now, quality of your financial reporting is very, very important. We are looking exclusively at your financials in making a determination if the bank wants to partner with you in this risk. So we want to make sure that your financial statements are of the utmost quality. We look at it for accuracy, for transparency, for consistency, and for completeness. We have a preference for tax returns or CPA audited reviewed statements because those are they're less likely manipulated. But we also use the company prepared financial statements as well, because as a business owner, you should be able to produce those documents and know what those documents are saying for your own business as well. So we do encourage our business owners to actually have their company prepared financial statements at any point in time, because we know the tax returns are like annually. So we can look at your company prepared financial statements for a period, for 9 months of the year, 10 months of the year, while we wait on you to get your audited or your tax returns done.
Amazing. Thank you so much. That is great insider information. So now we're back to our, what does a lender look for? So we're going to kind of, I guess, tie all this in together, EBITDA projections, industry benchmarks, and what does EBITDA tell lenders?
Okay, so the EBITDA tells a lender how much a business can generate that can be used to repay debt without the certain noise. We spoke about this a couple of slides ago. The bank is looking exclusively for your core operation. That's going to determine what your EBITDA is. So it gives a clearer picture of operational cash flow and the potential that operational cash flow is going to translate into income. Now, this shows your ability to pay debt, as we talked about before. And one of the importance with projections is when it comes to lending, investing, or running a business, projection will show a future story, while historical financials tells us what has happened in the past. Projections will tell us what is likely to happen and whether the repayment is realistic. And here's why projection matters so much. They show your ability to repay future debt. Will revenue grow? Will revenue decline? Or will revenue stay flat? They reveal assumptions. And these assumptions are very, very important to the bank. And we'll walk through a couple of them. Now, they reveal growth rate assumptions. Now, is the customer saying to us that they're going to be growing their revenue by 20, 30, 40% year over year? What's driving that growth rate assumption? What kind of research has the customer done to make that determination that their revenue is going to grow by that level of growth? Your projections are going to detail exclusively to the bank what it is that you believe is driving those assumptions. You've done your research. You're going into this new market that you've never ventured before. This market is expanding, it's exploding. And this is why you believe that your numbers are optimistic or realistic. They also show us what your pricing assumptions are. Now, you're expanding your business, you're growing your business, you're venturing forth into a new market. How are you pricing the products that you're selling? How comparable is it to what's actually going on in the market? Your pricing assumptions will reveal that to us. It will also reveal what are your expenses? How are you projecting your expense to increase in line with your revenue? In a perfect world, your revenue will grow 20, 30, 40%, and your expenses remain flat. But that's not the world we live in. It's expected that your expenses are going to be growing alongside your revenue. And how are you managing that? You're going to have to pay rent if you're going to be transferring to a new location. You might want to expand into a bigger building. You're going to have to pay rent. You're going to have to hire personnel. You're going to have increased insurance. Your projections should ideally match growth in expenses along with growth in revenue. A misconception with a lot of customers is they want to keep their expenses at a minimal level while showing revenue growing proportionately out of control. And the lender is going to look at that and wants to make some assessment of that. We are going to stress that because it's not realistic that your expenses are going to be kept at a low level while your revenue is growing. We want to see what your CapEx plans are. We want to make sure that your projections also includes the upgrade to the equipment that you're going to be needing, the upgrade to the software that you're going to need, all again to support your business growth. And then we also want to see market conditions from your assumptions. What kind of research have you done to determine that this market is the ideal market for you to venture forth in? You have a lot to lose with this expansion. The bank also has some to lose. So we want to make sure that you are doing your research. You're not just putting numbers on paper. You've actually done some research. You know what's driving your numbers. You can speak to your numbers and you can attest to the accuracy of your numbers. So when we talk about industry benchmarks, for instance, now industry benchmarks are standards or averages from businesses in the same industry. So we look to see how we can evaluate your company's performance as they provide us with some context. No, not absolute judgment, because everyone will run their business differently, but we do look for the industry to look at context. On average, if your business is a business that earns $10 million per annum, you're operating again in the landscaping industry, you have 5 to 50 employees. We look at the industry for similar concepts to see how are you planning, how are you projecting, does this align with what the industry is actually doing?
Makes sense.
So we compare your profitability, your efficiency, your liquidity, your leverage, and your growth patterns with what the industry is telling us. Now, this benchmark can turn raw numbers into insight, and it helps lenders and you as the business owners to understand whether your business performance is strong, average, or weak relative to your peers in your industry.
Sandy, that was great. Thank you so much for sharing. And then, so now we're going to transition. Again, Sandra, thank you so much. This has been so educational. And I think it's just so great that the bank has put this information out there for our clients or potential clients to see, our teams to see, because it just helps us be more educated and help answer questions when we're out there visiting or, having that conversation.
Absolutely.
So, we'll see if we have any questions out in the queue, but we do have some questions for you.
Okay.
So I'm going to take that away if I could.
Absolutely.
So again, a great information. But one of my first questions would be, what happens to cash flow if revenues drop between 10 to 20%?
Okay, so most businesses, and that's a great question, and most of our customers would ask a question like that because they're curious, what will happen to their cash flow if revenues does drop? So most businesses have high fixed costs. They have payroll, they have rent, they have software, they have debt repayment, and they also have variable costs that also don't flex instantly. Whilst they're variable, they don't necessarily go down. So if revenue drops and your cash inflow falls immediately and the cash outflow falls slowly or not at all, there is an impact to the bottom line because they don't move at the same pace. Your revenue drop, but your fixed costs and your variable costs stay constant. So your cash flow definitely will get impacted if that happens.
That is great to know. And on to our next question. So, what leading indicators warn of cash trouble early?
Another great question that we see a lot with our CNI businesses. So the early indicator will be how your working assets are performing. And your working assets are your receivables, your inventory, and your payables. So if your accounts receivables are growing faster than your revenue, that's an early indicator of trouble. If your inventory is building up, you're not selling as fast, you have your inventory stockpiling on your shelf, that's also an early indicator of trouble. If you're stretching out your payables, you're taking a longer time to pay your suppliers, that's also another indication of trouble. So your working assets, those three elements are the early warning signals that you should be looking out for.
And I think that kind of ties into tell the story, do the homework, really get to, get into the deep of your business and all aspects of it. My next question would be, if I had to ask one question to test whether a business is truly ready to expand, this would be my question. What breaks first if demand doubles tomorrow?
So another great question. What breaks first if demand double? And the first thing And almost always the first thing is cash. Cash will break first. And the reason being is you have to pay for your inventory, your marketing, your labor, or your infrastructure now. You have to pay for those upfront. Well, your customer pays later. So you have to expense those immediately and you collect at a later period of time. So as a result, your working capital is going to explode. You're not going to be able to collect on your receivables to support your core business operations. And that's why the business will need to have support on hand to meet this demand. So if your demand doubles, you need to have a conversation with the bank so we can see how best we can support you to meet that demand, because your core business operation might not be enough because you're selling on credit. You might have 30, 60, or 90 days receivables waiting to be collected, but you have to meet your marketing, your labor, you have to meet some upfront costs right now. So cash would be the first thing that breaks.
That is a great answer. Thank you. And then my next question is your core business consistently profitable before growth?
So another great question. What core profitable means is that the existing customers are funding the business. Operating cash flow is positive at a steady pace, and your margins are not collapsing with modest volume. So we do a self-check here for yes and no, and we're going to walk you through what this means. So I'm going to ask you a series of 5 questions, and then you'll see where we're going. Is your cash flow positive with 0 growth over the next quarter? Does existing customers cover fixed costs? Is there a positive contribution margin before marketing? Are there predictable collections? And can you pause growth without breaking operations? Now, if you answer no to any of these, meaning your cash flow is not positive with 0 growth, your existing customers does not cover your fixed costs, there is not a positive contribution before marketing, there are not predictable collections, and you cannot pause growth without breaking operations, that means your core is not consistently profitable. If any of those answers are no, your core is not consistently profitable.
So it's a great check the box list for yourself to kind of see if you're ready to take that step.
Yes.
That is fantastic. Sandra, my next question, where will the expansion strain cash flow in the first 6 to 12 months?
Okay. Another great question, and something that we see a lot with so much of our CNI customers. The number one strain is your working capital. And why this hits early, as we spoke about before, is there's certain things that you have to pay upfront. You have to pay your suppliers, you have to pay your staff, you have to pay marketing, you have to pay insurance. You have to pay those upfront. While your customers, as I've said before, they're paying you later. The customers are not paying you on time to make these payments. So the number one strain is going to be your working capital.
These are great answers. And then my last question is, we hear most businesses don't fail loans, they fail covenants. How often are covenants tested? And can covenants ever be amended? And I think that that's one of the questions that we get the most of is, again, how many times are they tested? And do we ever go throughout the, period of that loan, do we ever amend them?
Okay. So covenants are tested at the discretion of the bank. Typically, it's annually, but the bank does have the option to test them on a quarterly basis or even a monthly basis. Annually is the preferred method that we use, and covenants gives the bank a little bit of a control over certain expenses. It also gives the customer an insight into how they can manage certain things, because if they know that they have a debt service covenant, for instance, with a bank, they know that they're going to limit or restrict certain spending. The bank does have a conversation and open dialogue with the customer. These covenants, it's not a get to jail kind of thing. It's always a conversation, and the bank is always amenable to see, okay, based on how you're operating, maybe we can revise some of these covenants. They can be amended if at the bank's discretion, and having a conversation with the customers, seeing how the business has been performing, see how operations is going. The bank is always amenable to revising these. It's not a death sentence, but it is a tool, like I've mentioned, that the bank used to control, to make sure that the customer is meeting. Again, it's debt obligations, because that's always the key. Is your business paying the debt obligations that it's supposed to pay? So that's the thing with covenants. It can be applied at the bank's discretion. It can be amended at the bank's discretion, and the bank will always have a conversation with the customer about that.
That is a great answer. Thank you so much, Sandra. And I will say that it has been nothing but a pleasure. It's a pleasure to work with you every day. And I appreciate, how open and how knowledgeable that you are. And again, this has just been a great opportunity for us to spend this time together, but also to educate all of those who have joined us today and hopefully continue to join us on these calls. So I want to thank you on behalf of Northern. Sandra, it's just, again, pleasure is all mine.
Thank you so much, Yvette. Likewise. And I wanted to add, I think we have a QR code that our customers can scan to send us any follow-up questions.
I'm going to see if that's on there. Yes, it is. If you want to continue the conversation, or if you didn't get to your question, again, please utilize that QR code and scan it, and we will get back to you with your answers. And again, I could have moved to that a little bit earlier, so I apologies for that. But I thank you so much, and this has just been a great opportunity to spend some time with you folks out there. And again, if there's a question on cash management, if there's a question on underwriting, or any questions about Northern Bank in any scope of any kind, please feel free to jump on there and we will be happy to answer. And we hope that you will join us again in the future. So thank you and enjoy the rest of your day.
Thank you, guys. Bye.